Okay, are we live now? Gary? Hello, can you hear me? Okay, so we're live now. All right, awesome. Good morning, AIA, dear life planners and AIA advisors. Welcome to today's morning meet. My name is Yihua and I'm from AIA Premier Academy, and I'll be your MC today. Before we all start, I just want to remind you to ensure that you have connection to a strong Wi-Fi. If you ever experience lagging or some issue you cannot hear the sound, please log out and log in again. And I encourage you to interact with us, put in your questions into the chat box, because today our topic is very interesting and I'm sure you have a lot of questions. And of course, our attendance will be reflected into your islands in 5 working days. Now, ladies and gentlemen, did you notice that after you generate a quotation for a customer, there's a document inside the iPost called the Fun Fact Sheet? When our customers buy an investment linked plan, you will need to show them the Fun Fact Sheet. However, there is a question. What does it represent and how to read it? What is the 2024 Malaysian investment outlook and also the strategy? And in other words, where to put your money? That is a question that all of our customers will love to know the answer to. So don't worry. Today we are very glad to have invited our 2 guest speakers to help you with that. We have Ms. Ng Pei Chen, Head of Fixed Income, and also Ms. Goh Pei Kwan, Head of Equity from AIA Berhad. They are here to give you some very, very important insights. So, without further ado, let's welcome our first speaker, Ms. Pei Chen.
Hi. A very good morning to all AIA leaders and life planners. Like my colleague has shared, my name is Pei Chen. I'm the head of fixed income from the investment department. It is a great honor that my colleague Pei Kwan and myself are invited today to share with you on our investment update on Malaysia. And we will walk you through our fun fact sheet. What does it really represent, and also how to read it, where to put your money in 2024, and if equity funds are ripe for re-rating. Now I have projected up my slides. I hope everyone can see the slides. Okay, all right, I'll start off with the presentation. Okay. The first one is on investment linked fund information, where it is covering the fund fact sheet and the monthly fund performance update. So in this slide over here, you can see that the link here will link you to the site here, which will show you where you can download the fund fact sheet and also the monthly ILP highlights. Now, I will walk you through the fund fact sheet later, but the monthly ILP highlights basically tells us what are the key performance for the month and what is the key composition of the fund during the month. And at the bottom, we also have monthly fund performance update. So on the monthly fund performance update, that is updated on a monthly basis, where we capture the fund profile, investment objective strategy, and also the sector concentration and the performance update for that particular month as well. If I may, I will move on to the next slide, which captures the fund fact sheet and the monthly fund performance update. So on the fund fact sheet, I'll just quickly walk you through the fund fact sheet over here, and just to go to the investment objective here, it lays out all the investment linked funds that we have within our ILP space. And we can see that we have a total of 21 ILP funds. So investment objective here basically tells us what the fund is intended to invest into and what it wants to achieve. So I will take AIA Balance Fund as an example for this particular illustration. For AIA Balanced Fund, it says here is to maximize total returns and to have a reasonable safety of principal through investment in diversified portfolio into various instruments, including equities, fixed income, and cash equivalents. So it is suitable for what type of investors, and it's stated here for those who are willing to take moderate risk in order to achieve a reasonable return. Over to the next segment, that we have the strategy and approach. And for the strategy here for Balanced Fund, it tells us that what instruments it is going to invest into to achieve the objective. So it invests into a various type of instrument, including the ringgit corporate bonds or debt securities, or debt is debt issued by government or government guaranteed securities. And it also includes investments into Malaysia equity stocks and warrants. And the asset allocation is really based on two factors. One is on the top down when we look at the macroeconomic outlook, and also bottom up, which is based on fundamental analysis of each of the stock. So that is how we want to achieve our investment objective for AIA Balanced Fund. So if I were to move on to the next section for fund fact sheet, it spells out the asset allocation, performance benchmark, and the fund manager who manages the fund itself. Taking back on AIA Balanced Fund, over here, we can see that there is a target asset allocation of 70% into equities and 30% into fixed income. And then it also states here that it is a local fund. That means there is no foreign element into this fund, purely in Malaysia. And over here, it also says whether it's Sharia or non-Sharia. So when you recommend to your policy holders, you will know here whether it will fulfill their requirement, whether it is a Sharia fund or non-Sharia fund. And also over here at the column, there is a benchmark. It is basically telling us what is the proxy to measure the fund manager's performance, which is over here given is 70% equities. It is 70% into FTSE Bursa Malaysia Top 100 Index. And the remaining 30% is in a bond index. And over here, it is the MGS All Index. And over here, in the fund fact sheet, it also shows the fund performance as of the date that it is published. And the fund manager over here is AIA Berhad, meaning to say it is an internally managed funds. We also have other funds that you can see. It is a fund manager that is other than AIA Berhad, for instance, Elite Conservative and Adventurous Fund, which fits into funds that are invested by the AIA Investment Management Private Limited, our sister company in Singapore. And there are others where it fits into other funds like funds managed by BlackRock Financial Management and etc. So these are all elite fund managers that we have exposure to in terms of foreign investments. Okay, so next segment over here, we have the fees and charges. Basically lays out of the 21 funds here, you can see what are the charges for each of the fund. So the lowest being 0.5% and the highest being 1.5%. And all these are in line with Bank Negara guidelines. And next segment, we have the fund performance for every single year. So this is the latest published for last financial year. So you can see that it will have performance breakdown on a yearly basis for December 2022. That means the full year of December 2022, December 2021, and etc. all the way to the last 5 years. So if you want to illustrate to your clients like how AIA Balanced Fund number 7 has performed, you can show the track record for the past 5 years here when you do fund recommendation. Here, basically, the next segment here, it says fund that invest in collective investment schemes. It's basically those foreign funds that we have. And we do have exposure, like I mentioned just now, into funds that are managed by foreign fund managers. because of their expertise and their access to the foreign capital markets. So we have laid out here what are the funds that have access to foreign funds and managed by who. So it's all stated here. And what would be the allocation of the fund into adventurous and conservative fund, and the entire fund performance. We have the risk of each fund stated in the next slide here over here. So taking balanced fund as an example again, it shows us what balanced fund is exposed to. It is exposed to a combination of market risk, definitely, because you invest into equity and fixed incomes. You have liquidity risk, that means the ability for the fund manager to buy and sell the securities within a stipulated time to generate a return. And interest rate risk occurs when you are exposed to fixed income. And then stock risk, of course, when you are exposed to equity, you will have stock risk. Credit or default risk is when you're exposed to fixed income bonds. So definitely, other than just investment into government safe bonds, we also invest into corporate bonds, like, for instance, those bonds issued by big corporates like Tenaga, Telecom, etc. So you are exposed to the risk of these investee companies. You have country risk, and then you have currency risk if it's a foreign fund. Reclassification of Sharia status risk is if those are the Sharia funds. So when Sharia funds, from periodic basis, the Securities Commissions will release what will be the latest Sharia compliant stocks, and then some may be excluded, some may be re-included. So there is this risk over there that the fund manager would need to review periodically when they manage the funds as well. Derivatives risk is if the fund in particular engages into any instruments that hedge any risk. So there is derivatives risk. Regulatory risk is pretty common for funds, especially when it is a foreign fund. So you are exposed to regulatory risk outside of Malaysia. And then after that, following the risk, we have other information basically capturing the risk profile that is suitable for your customer. So for instance, taking balanced fund again, it is suitable for a moderate risk profile customer, as opposed to, for instance, AIA Equity Plus Fund. It's more suitable for a high risk profile customer appetite. And for the lowest risk appetite for customers, it would be the AIA fixed income fund. So that we have an array of funds that meets all those low, moderate, and high. So yeah, that sums the walkthrough of the fund fact sheet. Of course, if you have any questions at all, you can post it in the Q&A chat box. Next section, I will walk you through the monthly performance update. So the monthly performance.
Pei-Chen, sorry to interrupt a bit. Maybe you can share with us the link in the chat box to the fund fact sheet.
Okay. Is it okay if I share it with you later after my presentation?
Yeah, but we have a live planner asking where to download this. I think they will want to have it alongside this presentation lah.
Okay. I see if I can copy this.
Are they available on the website that we can search
the link
on?
is over here. I've shown the link here.
Pei-Chen, I'll copy it onto the chat box.
Yes, yeah. Thank you.
Okay, thank you.
Yeah.
Sorry, if I may carry on the monthly fund performance update and how do we read it. So the monthly fund performance update is available every month, and it is actually capturing the investment objective, which I've shown you in fund fact sheet. They have also the fund details over here where there is a bigger zoom on the table. It captures the NAV as of the date where the fund performance update is published. So over here you can see balance fund, the NAV is 4.13403. And then what is the fund size as of that date, which is 2.36 billion. Currency in Ringgit Malaysia, because it is a purely local currency fund. Fund inception, that means the starting date where the fund was launched, it was back in 15 March 2000, so it has got a long track record. We have the offer price at inception, which was 1 ringgit, and now you can see that from 1 ringgit over the time, it has appreciated to 4.134. Fund management charge is 1.2%. Investment manager is our local investment house, AIA Berhad. It is valued based on net asset value basis, and how frequently it is valued, which is on daily basis. So on the next section over here at the bottom, it has the top holdings where it shows our top exposures are to Maybank, CIMB Group, Public Bank, and then we have also the Malaysian government bonds, and also Tenaga Nasional Berhad. Asset allocation wise, in this pie chart, it also shows you how are we exposed to in various sectors, how much is in cash, how much is in fixed income, and how much is in equity and the sectors that we are exposed to. For instance, finance is the biggest pie in this chart. We also have industrial products and technology, which are the later two biggest exposure. And we have the historical performance since 15 March 2000. And you can see here, the red chart, the red line is basically capturing the fund's performance relative to the benchmark. The benchmark is really a proxy to measure the fund manager, how we have performed. And we can see that we have far outperformed the benchmark since inception. The gap is so wide. And the summary in numbers is shown in the table below, that since 15 March 2000, the performance of the fund is cumulatively 313%, and it has outperformed the benchmark by 201%. That is a very good outperformance here. And it basically captures the investment decisions that the fund manager has made over time to capture this wide outperformance. So basically at the bottom of this slide, you can also see over here, if you see, point to my cursor, if it is recognized for any fund ranking by the industry, which is here the Lipper Leader Fund, and it is showing it is one of the top funds for consistent return. So this is something that you can also show your policyholders. So yeah, so this is basically a snapshot on how we read fund fact sheet and also the monthly fund performance update, which I hope it is helpful for you to explain to the policyholders when they have any inquiries into any particular fund at all, and that AIA Berhad investment team and the marketing team will continuously upload monthly updates on these funds into the website, and the link shown in the first slide, and you can gather the information from there. Yeah, so that is the section on fund fact sheet. Without further ado, I will go over to the fixed income outlook and strategy segment, which I'll cover before I pass on to my colleague Pei Guan, who will share the equity outlook and strategy with you. I will have, firstly, just to share with you, you may have heard of the International Monetary Fund in the papers projecting what is the growth for 2024. And basically, as of the latest projections, they have the projection for world growth for 2024 to be slightly weaker than 2023. So you can see here 2023, they are capturing a 3% growth. And for 2024, slightly weaker at 2.9%. If we break it down further by developed or advanced markets versus emerging markets like ourselves, advanced markets over here, you can see United States and Euro area, they are actually seeing much weaker growth. 2.1% in 2023, coming down to 1.5%. Euro area slightly higher, but it's still fairly weak if you compare to 2022. It's a 1.2% growth. Conversely, if you were to look at emerging markets and Asia, you can see that it is actually a better growth, albeit it is still slightly slower than 2023. So from 2023, it's a 5.2% growth, but 4.8% in 2024, still far exceeding the growth in the advanced economies. So why is that happening? So in short, just to share that you can see probably or hear in the news that the developed markets, especially the United States and the European Central Bank, they have been very, very aggressive in increasing interest rates from last year to this year. The US itself has increased the interest rate by 5.25%. And the European Central Bank has increased interest rate by 4.5%. So with such high interest rates, it is hitting the consumers and business pockets. And actually, it is impacting the demand, and the sentiment is also weaker. And hence, IMF is projecting a weaker growth overall for advanced economies. Next slide, I will cover very quickly on the US because US is a very big market that we cannot ignore, and it has very great influence into our local markets as well, especially on the fixed income space. So for the US, like I said just now, they have high interest rate by a total of 5.25% over the past 2 years. And if I may bring you back just a couple of years back when COVID hit, I have two charts here. One that shows the unemployment rate, basically showing us the strength of the labor market and the activities ongoing there. And also the inflation chart, basically a measure of increase in prices of goods and services. So basically when COVID hits, everyone were letting go of labor and people were laid off, and hence you can see a very steep uptick in the unemployment rate, right? And the lockdown also amplifies it, and basically a lot of people were left with no work and no job and lockdown, and hence over here you can see during the similar period, the inflation basically captured by the blue and the orange line came down. But when the reopening happened late in 2021, because the US opened earlier than us, you can see that the unemployment rate come down very starkly, because the business, when the US economy opened, there were labor shortage in restaurants, in hypermarts and everywhere. Everyone was rushing out to spend after being locked down for 2 years. So people were busy hiring labor and to fill in the vacancy positions, so that is able to serve the services sector and also the manufacturing sector to speed up to meet the demand. So you can see that a sharp slowdown in the unemployment rate in 2001 all the way to 2002 and 2003, and it's stabilizing right now. As for inflation, because people come out and rush out to spend, and people get back into employment, then they have cash to spend, inflation spike up during the period. So all these two things happen in opposite manner. So with that, inflation spike up so fast that prices become very expensive. When there is more demand than supply, then it generally push up prices. So with that, the US Central Bank has no choice but to hike interest rate by so much, 5.25%, so that to contain the inflation that's ongoing in the US consumer and business side of things. So with this hike, can you imagine the mortgage rate over there in the US 30-year is about in excess of 7%. That is very high. For those people who have served monthly mortgage payments, is 7%. So that is how the US Central Bank has taken in measure to contain inflation and also to also contain the labor market activity, which is too hot. So basically, the objective of the central bank is to push up a bit on the unemployment, and then hoping with that to see the inflation to come down. So it is generally, with this quantum of hike, is generally working right now, and it is expected to continue into next year. And hopefully with that, the US Central Bank can then gradually reduce the interest rate a bit, so that to lessen the burden of businesses and consumers with the high interest rate, for instance, for their borrowing rate. Yeah. And this chart basically just to show you yield curve inversion, just to put it simply in layman terms. When the US government needs to borrow, there are various tenor of maturity. They can borrow from investors as short as 2 years, and then they can borrow as long as 30 years. Typically, when the shorter the tenor is, the interest rate should be lower. Say hypothetically, a 2-year interest rate if you borrow is 4%. So technically, 30-year, because it's longer tenor, the investor is exposed to a longer risk to the US government, then the investor will demand more premium to borrowing, to lending on a 2-year basis. So perhaps 30-year could give you 5% or slightly more. But now this is not the case. You are seeing 2-year lending rate at 2-year borrowing rate by the US government of 4.4%. But 30-year is lower at 4%. So that's very peculiar. And why does this happen? Basically, this is not the first time it happened. It did happen before. In previous episodes, like I've circled here in the yellow, blue, red, white. So these are the previous episodes where in 1979, there was the great inflation. The same thing happened. And then there was a Black Monday in 1989. There was a dot-com crash in 2000. There was the global financial crisis in 2006. So when these happen, usually it is a sign that a recession is coming. So now it is also happening. So the question is whether a recession in the US is coming, or is it if the central bank is able to navigate its way without having to land in a recession. So that is the question that everyone has in the investor's mind. And if I were to come quickly to Malaysia, Malaysia in terms of growth, this year we have got a 4% growth, and next year we're looking to 4 and 5% growth. Basically, Bank Negara is expecting better growth next year on a few things. One is better labor market conditions. Similar to the US, the unemployment rate is low, very close to pre-COVID period, and hence that is encouraging spending by consumers. There is progress in infrastructure and investment projects as announced by the Prime Minister through the budget. We have the possible better exports number from the recovery in the global tech cycle, and also possibly continued rise in tourism activities. We can see that the government has taken measures to provide visa-free to the Chinese and India tourists already. So this is a sign that the government is encouraging more tourism activities into Malaysia, and that is expected to improve next year compared to this year. And for inflation for Malaysia, we are seeing about 3% of inflation right now, while our overnight policy rate, our interest rate that is controlled by Bank Negara, is also at 3%. But what we want to highlight into 2024 is that we could potentially see slightly higher inflation, maybe within 3 to 3.5%. That is purely because of the subsidy removals and the lifting of price controls by the government that they have announced so far, and maybe soon to be announced next year. So this is something that we will be watchful of, because if inflation goes higher, then the question is whether Bank Negara will also increase interest rate like what the other central banks have done. But at this juncture, we think that it does not warrant any further increase in interest rate right now by Bank Negara, because any subsidy removal is always done on a very gradual basis. So it will not cause inflation to suddenly spike up, and it will not cause a sudden surge in demand in goods and services. Other things that we need to watch for that could further increase inflation could be the commodity prices if the geopolitical tension intensifies, and that may increase oil prices. And if our currency continue to weaken, then we have imported input costs and inflation from the currency weakness. And on the budget that our Prime Minister or Finance Minister have shared a couple of months ago, something just to summarize here, basically what the government has focused on is to control their expenditure and also try to increase their revenue. So they have increased their revenue by a few fronts, like lowering subsidy allocation. So they lifted price controls and chicken and eggs that saved them 2 billion. And then the scale back of electricity tariff subsidy that saved them 5 billion. And then the diesel subsidy removal also saved them 4 billion. All in total saved them about close to 12 billion. So with that, it saves them a bit on expenditure. And then on the other hand, they also try to increase revenue, for instance, by increasing service tax by 2% from 6 to 8%. So all these measures are generally positive in terms of the government's financial balances. So when that happens, then it is viewed positively by the sovereign rating agencies on how they want to rate Malaysia relative to our neighboring countries, or even countries that are similar rated to us, and also foreign investors' perception of Malaysia. And on the budget deficit over here is also to capture basically our government's need for borrowing to continue developing the country and to achieve a certain target of growth, say 4 to 5% for next year. So currently our deficit, that means our revenue is shorter than the expenditure, hence the government need to borrow, is at 5% deficit. So they will have to they intend to reduce the deficit over time, over the next 3 to 5 years to 3%. That is also a good sign because the government is disciplined in containing their deficit and also in containing their borrowings, not to make sure that they don't over borrow and don't over leverage. They also have limits imposed on themselves on how much they can borrow from as a percentage of GDP, which is set at 60% over the next 3 or 5 years. So all these measures that has been announced in the budget recently is also a positive basically to the market and the sovereign rating agencies. Very quickly on the fund flows that we have seen in the fixed income market, foreign investors have been coming into the Malaysian bond market. We have seen a net inflow or net buying from them of 26 billion this year. That's very encouraging. But having said that, that has not really helped our ringgit. That you can see over here in the chart, we are close to 6% depreciation against the US dollar. And that is largely because of a few things, dollar strength, and also we are highly correlated to renminbi because we have a lot of trade activities with China, and hence that is the drag to the ringgit. But however, next year we are expecting a stronger ringgit. That's on the back of a few fronts, like I've mentioned just now, which is better tourism arrivals, better exports outlook, and also potentially better fund flows into both equities and fixed income from foreign investors as well. This is just a snapshot of how our bonds have performed relative to US bonds. Basically, US bonds this year have suffered and they have suffered losses in terms of prices. The interest rates increase by the US Central Bank has caused the bond prices to decline, while our Malaysian bonds, even though the Central Bank, Bank Negara, has increased interest rates, we saw that the bond prices actually increased. So that is a positive because there is very strong foreign investor buying into our local bond market and also strong support from the domestic investors. So to sum up our view for 2024 for fixed income, I would say that we are overall slight positive for this asset class and hence the ILP funds that you may have in the selection. That is on the back of better growth prospect for next year compared to this year. And then US interest rate increase could have peaked already. So meaning to say the next interest rate move by the US Central Bank could be a cut rather than an increase because inflation is already well contained right now. And also on the local side, our budget planning in terms of government debt borrowing has been in place and is properly laid out. So it is a favored move by foreign investors, domestic investors, and sovereign rating agencies. However, on the flip side, we are a little bit concerned of potential inflation upside risk on Malaysia if there is further subsidy rationalization or lifting of price control measures that could be a risk to inflation and hence the need to review whether Bank Negara need to increase interest rates. And lastly, whether there is going to be more government guaranteed borrowings in the likes of Dana Infra for our LRT development, etc., going to next year and the year forward. That is something that foreign investors will also look at. So generally with these 3 greens and 2 reds, we are slight positive with fixed income, and that sums our view that we will have a slight overweight in duration strategy. That means we are comfortable taking higher and longer tenor interest rate risk, and we will focus on corporate bonds with sound credit fundamentals, and we will continue to trade to get the gains for the ILP funds. And over here, I won't go through in detail. It captures the risk that we could potentially face to our call for fixed income. And I will pass it on to my colleague Pei Guan for the equity outlook and strategy. Sorry, Pei Guan, can't hear you.
Oh, sorry. Thanks, Pei Chen. Thanks, Pei Chen. A very good morning to all AIA colleagues. Let me quickly share with you my slides. We will continue with the session on equities. Sorry, just give me a moment. Okay, just to check, can you see my slides? Yeah, okay. All right. Okay, so yeah, we have heard from Pei Chen and, you know, a very elaborative chat or discussion that we had on how to check on the fund fact sheet and also the monthly updates. You know, very insightful presentation on the fixed income market outlook. So I'm sure all of you have the question is, what about equity? What is the outlook of equity market, and is equity funds right for a re-rating? So my quick answer to you is actually in this slide here, where I think this presentation, I look to address 2 issues here. One is where to put your money in 2024, and I'll start with the conclusion. Our answer is that it's actually equity funds. And second question is equity funds right for a re-rating? My answer is yes, it is. And I'll share with you the reason why we think that equity funds continue to have legs to be further re-rated in 2024. So let's have a very quick look in terms of how the equity has actually performed. If you see from this chart here, is actually a chart since 2021. And let us just focus on this bit here. I mean, over the last couple of years, I don't think market has actually done well. We can actually see that market has actually came off. But the good news is that we did see that market has started to actually turn around. Equity market started to turn around sometime in June, and as of June up to end of November, we did see that market was actually up by 5.7%. And I'm sure you'll be wondering what are the key reasons resulted in this re-rating. But before that, let me just rewind one step back to share with you where market, what market has actually done in 2023. Okay, the first table here actually shows you how market has actually performed up to 30th July 2023, meaning for the first 6 months of 2023. You can see that Malaysian market is actually has actually registered a negative return of about close to -4%, making it one of the worst performing market in 2023 as of end July 2023. But and the reason for the poor performance in the market were actually due to weak currency, because we do have ringgit do have a high correlation to CNY, and two, I'm sure we do know that we had so many changes in the Prime Minister over the last couple of years. So the level of confidence in the Malaysian market was fairly low. And at the same time, because of these lack of focus into growing the economy, we have lack of fiscal reforms, policy growth initiatives, because when there is change in the government, certainly the policy direction has been pretty unclear. So that was the reason why equity market actually underperformed during the first 6-7 months of the year. And you can actually, like I mentioned, I think the earlier presentation that I did to some of the other investment community, I did say that sometime in July, market is actually right for an inflection point. And true enough, we can see that this table is as of 22nd of November, and the market has actually turned around, and we did see that market has actually recovered. And since 1st July 2023, market is actually up by 8.3%. So what actually sparked the turnaround, we will share with you later. I'm sure some of you will be wondering why are we going to see further re-rating in the market for the rest of the year and into 2024? Our answer to you is that yes, there will be further re-rating in the equity market. Okay, so what are the catalysts that you are seeing for 2024 for equity market, and why are we positive, and why are we saying that equity market will continue to re-rate? Well, these are the few key reasons. One is on the politics. It's pretty clear that market has actually seen a recovery on the back of better clarity in politics. What we can say is that the next general election is only going to happen in 2027. So we will see a few years of political stability, and we are of the view that this current unity government will continue to stay in power. And this would definitely be positive news for equity investors, given that we have better clarity, better certainty of the policy direction. And as a result of that, there has been roll out of fiscal reforms, which market has been looking forward to. And this has actually resulted in setting the country in a better footing moving forward. And what is even more interesting is that there have been announcement of some new growth initiatives that we have actually seen by the government. there are three key things that we believe has actually set the Malaysian corporates into the earnings growth recovery coming from these few growth initiatives, one being the renewable energy. I'm sure all of you have actually seen that in the Malaysia space, the government has actually announced that there is this National Energy Transition Roadmap transforming Malaysia into a net energy exporter for moving forward. The second growth initiative is the Malaysia-Singapore Economic Zone. I think this is an economic zone where the government would actually focus on developing a few industries. We are still waiting for more clarity on these. And the third one is the resumption of mega infrastructure projects such as your HSR, LRT, MRT3, and this is certainly going to benefit a lot of companies like utilities, solar, property construction, and building materials. And the other growth initiative that we reckon will be the China Plus One relocation. We're going to see multi-year relocation of tech supply chain into Malaysia, as we have seen that there is actually a growing tension between US and China, and that has resulted in more and more companies relocating out from China into the other parts of Asia, and ASEAN is definitely one of the beneficiaries, including Malaysia. So I'll elaborate a little bit more about each of these growth initiatives. I think it's worth spending the time. We are excited on the ground to see that there is quite a number of positive catalysts that have actually started turning for positive for Malaysia. Like I mentioned, the National Energy, which is the National Energy Transition Roadmap, we have seen that there is so many announcements that has come forth. I think the government is actually targeting to, in fact, announce a single exchange for the transaction of selling of green energy. So we should hear more about that during the second quarter of this year. And also there will be a lot of, there will be a framework that is going to be set up. Hence, it will actually give more clarity to the entire policy direction for national energy transition in 2024. Like I mentioned, Johor Economic Zone, we have seen all these being announced by the government. We are also pretty excited, and this is certainly going to be very positive for some of the industrial landowner, particularly those Johor Land Bank owner, and it will actually result in a lot of spillover into economic activity in Johor. What is interesting is also the announcement or resumption of infrastructure project. We have seen that they have talked about the MRT3, and we believe that there will be basically some announcement coming for MRT3, LRT3. And what is equally exciting is the HSR, the high-speed rail. Although we have not heard a lot about when exactly this HSR is going to be implemented, but we are of the view that the government is actually pretty interested to ensure that there will be a resumption on this big infrastructure project. Certainly very, very positive for industries like constructions, and that would also increase the connectivity across Peninsular Malaysia all the way down to Singapore, and that would also increase the property value for land bank owners around this whole connection of HSR, MRT3, and also LRT up north in Penang as well. And the next slide here, what I would like to touch on is that, like I mentioned, one of the positive catalysts for equity market is the China Plus One story, where we're going to see a lot of foreign direct investment back into Malaysia, and we have experienced that over the last 1 to 2 years, and we do expect this momentum to further increase in 2024. What is interesting to highlight is on the table here, where there has been big amount that the government has announced that they have been able to secure FDI coming from Korea, China, Japan, Singapore, UAE, and also the United States of America. And the amount is actually large. For example, China, I think the potential investment that we're talking about is 170 billion. From Korea's 24 billion and Japan 23 billion. Singapore, UAE, and US is actually in the north of 20 to 60 billion. So yeah, so and the approved FDI has been picking up over the last 12 months as well. This is certainly very positive because the higher FDI will certainly have a lot of positive spillover into employment, economic activity, and hence would result into increase in asset value across Malaysia. Then moving on to the next catalyst that we spoke about is on Penang. We did see that there has been inflow of FDI multi-year supply chain relocation into this tech island of Malaysia. And at the same time, we also been hearing a lot of talks about the Penang Transport Master Plan and the South Island Reclamation, whereby there will also be creation, a lot of jobs, increase in property value in Penang, and also creation of a lot of employment opportunities as a result of these FDI flows into Penang. And just very quickly to touch on East Malaysia, not forgetting that East Malaysia is also going to experience pretty good growth initiative that has been announced by the government. I think Sarawak is one of the states that's also focusing on renewable energy, and we have been hearing that they also have been a launch of the hydrogen green initiative that the state government did, whereby we're going to see that Sarawak is also going to concentrate to become one of the green energy exporter moving forward. So we were very excited with some of these key initiatives that the government has actually announced. So just very quickly to touch on Budget 2024, certainly a step in the right direction. There is a lot of opportunities that have been created, and I think it will be positive for some of these sectors that I've highlighted here, positive for construction, property, building materials, utilities, healthcare. Definitely the step in the right direction as the government focus to rebuild the nation, to rebuild the balance sheet of the country by some fiscal consolidation announcement that they have actually made. Some of you also would ask about, market has actually gone up by about 7-8%, as highlighted by one of the slides earlier. Does the market continue to remain cheap? How is it compared to the previous valuation? My answer to you is that despite the increase in the Malaysian market over the last couple of months, equity valuation continue to remain cheap. As you can see from this chart here, this is the average PE valuation for Malaysian market, and currently market is still trading at this level. So there is still some room for market to be re-rated upwards just purely from a pricing perspective, and market would also continue to be supported by the EPS, earnings per share, as in the corporate earnings growth in Malaysia, which is also expected to be in the region of low teens for 2024. And in terms of foreign shareholding in Malaysia, you can see from this table here, it has been very low. There have been a little bit of an inflow back into Malaysia by the foreign investors in the last 2 months. But on a year-to-date basis, you can see from the chart here, foreign investors continue to remain as a net seller, but they have started change from a net selling to a net buying over the last 6 to 8 weeks. We did see some trickling of money back into the Malaysia equity space by foreigners. But there is still a long way for these foreign investors' shareholding to catch up back to the previous level that we have seen in the last 10 to 15 years. So in short, what we're trying to say here is that Malaysian market is ripe for re-rating due to the few positive catalysts that I mentioned, and is also supported by a pretty still cheap valuation. Market is not expensive, market is cheap. Foreign investors holding continue to remain very low in Malaysia. That gives quite a good potential upside moving forward. So what are the key risks for the equity markets in the next 6 to 12 months? One is that we're going to continue to monitor the subsidy and rationalization impact on the cost of living and doing business in Malaysia. Like we mentioned, government has come up with the fiscal reform. Certainly, the cost of doing business has moved up due to removal of some of the subsidy. At the same time, we are also watching very closely the execution of growth initiative on the National Energy Transformation Program, Johor Economic Zone, mega infrastructure project rollout. We are keeping our ears very close to the ground. We do need to see further execution, further roll up of all these initiatives to continue to support the market. The other key risk is, of course, the unity government. We have to ensure that for the market to continue to be re-rated, the unity government pact will need to stay in place. And we are of the view that this risk has actually come down a lot because we are of the view that this existing government is going to stay put at least up to the 2027 next election. And of course, the other risk is that we have to see the execution of the fiscal reform announced by the government. The other key risk for the equity market is the China property, which this is actually the global risk. But certainly this is still a risk. But what we would like to say is that for this particular factor, we have actually seen the worst. And the China property has started to stabilize, and we do expect further stabilization as we go into 2024. Because the Chinese government has actually announced a lot of initiative to support this sector to ensure that there is no further worsening in the sector. And with sentiment stabilizing, we believe that sales would actually start to show a turnaround for the Chinese property, and hence that would also support the equity narrative into 2024. So in short, what is our strategy for equities? We are advocating an overweight call for equity space in Malaysia. Like I mentioned, our call is supported by pretty good growth initiative. We have seen clarity of policy and direction for Malaysia, and also a much lower political risk environment for Malaysia, and that is also supported by low investors' position, especially the foreign investors in Malaysia. That would give a pretty good upside potential for Malaysia space into 2024. So some of the key thematics that we think will play out for Malaysia equity space in 2024 will be the renewable energy, Malaysia-Singapore Economic Zone, mega infrastructure projects, China +1 relocation, and also the quality big caps. So in short, we do prefer equity. I mean, you heard from Pei Chen that Pei Chen is also fairly positive on fixed income. But if you were to compare the two asset class, we are of the view that equities would be able to actually deliver a relatively better return than fixed income in 2024. And hence, there is a preference for equity funds over fixed income. We are generally pretty positive on the Malaysia market space. In fact, I must admit that myself and the team here, we are actually pretty excited for 2024, as we do see that there is a pretty exciting, positive story to tell for Malaysia equities coming from these few growth initiatives that the government has actually announced. So in short, equity funds definitely ripe for a re-rating and continue to have legs to be to see that re-rating to be continued into 2024. So a very quick look in terms of the ILP performance for equities. These are the performance for equities, foreign equities and foreign balance. And this will be the performance for local equities and local balance funds. And lastly, this will be the performance of the fixed income, which has actually shown very, very strong performance. I think Pei Chen and team has actually done a very, very good job here. Yeah, so that comes to the end of the presentation. So we're happy to take on any question from the floor.
Yeah, I see a couple of questions in the chat. I think Muruga has a question on the fund, which fund is doing currently well or historically. I think this last few slides that Pei Kwan has flashed out, it shows us the short-term and also the long-term return of each of the fund that we have. But in terms of suggestion to the client, I think it's still very important that you match to the customer risk profile, to the fund risk profile itself, so that it is properly matched and meet their requirements and their risk appetite. There's another question maybe for Pei Kwan from Julian, that is on the selection of fund recommendation to policyholder of aggressive type, and there's client asking about strategic equity fund where there is double-digit negative and the confidence about the fund.
Yeah, sure. Thanks, Pei Chen. Yeah, thanks, Julian, for the question. Yes, for clients that do have a bit more high risk appetite, certainly AIA Strategic Equity Fund is one of the funds that we would recommend, as it fits into the high risk bucket. We do notice that the fund's performance for this year has been relatively weak. That is due to generally the performance out from the Asia ex-Japan space, which have not done well this year. But moving into 2024, we are of the view that equity markets are definitely ripe for a re-rating. I think we have actually seen that given that the Fed has actually pivoted and had actually talked about, or rather market have actually started to price in a rate cut story, and that would certainly lend credence and also support to our thesis that equity will be re-rated in 2024. And therefore, we are of the view that for 2024, we do see that there should be a positive catalyst to re-rate equity asset class on the global side and also the local side. So within that two markets, local and foreign, we do have a preference for the local space, given that the local equity market do have a lot of positive growth drivers to drive the market upwards, and that would be driven by all the growth initiative, coupled with the global factor of a expectation of a rate cut. That would also certainly help to move the foreign markets into the positive direction in 2024. So we do think that we have probably seen the worst in terms of the equity asset class, and 2024 should see a better return for equity space. I think there's also a question by Noor Fahana. Is the current war issues between Palestine and Israel, how would that impact US or global market? If yes, how we want to convince and calm our clients? Yeah, I mean, very interesting, very interesting, and very topical question there. I would certainly say that the Israel-Palestine war, the impact, I guess the investors will watch very closely is how would that impact them. The Middle East region, which is a key oil producer for the global market. I think so far, as long as if the war is very much confined to that two countries, and it doesn't spill over into the other region of the Middle East, then we would, I would say that it will be very much an isolated case. But we're certainly keeping our ears and eyes very close to this issue, and to ensure that, or to watch how would this risk spread out into the other parts of Middle East. As long as it's very much confined to these two countries, then we are of the view that the risk is actually very low. And at this moment, it will be treated more like a short-term negative noises to the investment community. But once if this was spread out into the other Middle East countries, then certainly the risk would the risk for the other asset class would certainly increase, and it will be negative for asset prices moving forward. But as of this moment, it is actually low. So I would not be too worried about this particular risk.
Yeah, if I may chime in on the fixed income side, typically when there is any geopolitical risk or tension, in the US side, especially on the US government debt, it is deemed as a safe haven asset. So when that happens, the US government debt will outperform the rest of the world, and especially on emerging market, then the risk-off appetite by investors would drive the money away from these countries into safe haven assets in US. But having said that, this year, even though there was this tension between the two countries, we have not seen much of a price action in the emerging market, including our Malaysian government bond debt. And we did see some reaction on the US government debt where the bond prices increased on the US side when there are news headlines on the tension. But right now, it is calmer, like what Pei Kwan has mentioned. And if you know, in future, if it were to intensify, this scenario would apply. But in terms of Malaysian government bond market, we don't expect any much of a drastic movement in short.
I think there is a next question by Junzi on the projection of the 2 and the 5%. is the projection considered low than our actual performance, or is it actually higher? I think a very good question here. I think what I would like to point out is that if you actually look at the performance of the funds, I mean, if you could see the screen that I'm sharing, you can just a very quick eyeballing the annual return of, say, for instance, equity or balance fund. You can see across the board here, those that is not highlighted in or rather not bolded for this column that I am showing here, those would be the annualized return of the fund since inception. And a quick look at it, you can see that for the local equity or balance fund, it is ranging anywhere between 4.7 to as high as 8.66%. So certainly above that 5% that is in the sales illustration. For local Sharia equity and balance fund, it's a bit of a mix here, anywhere between 3.4 to 6.3%. And I think for fixed income here, you can actually see that the return has been strong. Even for the local fixed income is anywhere between 4 to 5%, and foreign fixed income is 1 to 5%. So certainly there is a case to I would say most of the funds since inception, they have actually delivered a better return than the sales illustration. The other question is if customers who want to invest in dollar related fund, any fund recommendation? I think I will just kick off with equity, and perhaps maybe Pei Chen can actually supplement on fixed income. So investment in US dollar related fund, I would say it will probably be more on those funds that are directly exposed to the global market. So in this case would be there's an AIA Global equity fund, AIA Global Balance Fund. So those funds, or also the elite funds, those funds would be funds that are directly invested in the global market, i.e. mainly the developed markets such as the US market. So that would actually give you the direct exposure to the US dollar. Over to you, Pei Chen, on the fixed income side.
Yeah, sorry. Pei Guan, if you don't mind to make the slide full screen, I think there is a request that they can.
Sorry.
No worries. Sorry. Yeah. So for foreign fixed income, I think in this slide that Pei Guan is flashing right now, we have two funds here. The strategic fixed income fund is the one where there is 70% local exposure and 30% foreign exposure. So this is a mixed exposure if your client wants to have a little bit of exposure overseas. And the global fixed income fund is the one that is 100% foreign. And this is the one where we invest into mainly Asia ex-Japan fixed income, and also to some extent global US fixed income.
Okay, so sorry, Pei Chen, when I'm sharing the slides on the slide mode, I can't see the question. If you could just help me out, please.
Yeah, there is the next question on what are the funds that focuses more on Asia.
Oh, right. Okay, thanks, Pei Chen. So for equity side, funds that focus more on Asia will be Asia Opportunity Fund, so that's one of it. Yeah, so this is the one that is probably fully fledged Asia ex-Japan. There is some Asia exposure in strategic equity, and a very tiny exposure in global equity. In global equity fund. Yeah, so those will be the one for coming from equity space.
Yeah, as for fixed income, we don't have a fund that is fully focused on Asia fixed income. Yeah, like I mentioned, strategic fixed income has local exposure and global has a mix of US and Asia that provides diversification. Next question we have.
Sorry, I have to jump in here, Pei Chen and Pei Kuan. Due to time constraint, we have to probably end this session over here.
Okay.
Yeah, I thank you for you guys for the informational sharing. I think all of our live planners have actually gotten a lot of knowledge from here, from the sharing today. So, sorry to all the live planners to actually put in all your questions. We are unable to answer them now. But I think for those live planners with the questions we've answered, I hope that it's very useful for you guys. So right now, I would just say thank you to Pei Chen and Pei Kuan for spending the Wednesday morning with us, sharing with us with all this strategic outlook for the market and all about the equity funds that we should actually pay attention to because it's a very positive outlook for us, for the local and also for the global funds. Now, without further ado, I just have one announcement for all of you here. Okay, can you guys see my screen? Yeah, so I just want to remind all of you here who actually know this Dragon Prosperity Challenge. All right, it's actually been launched since October. It's been running for more than 2 months right now. And if you haven't grabbed it yet, please go and do the requirement right now because as you know, we have 3 rewards, 3 different rewards. We have the packet of the ang pao packet. We have also the gift box with a very nice Montego customized flask. And for the third higher range of the rewards, we actually have added one NGIS gold pin. Now, how to get these rewards is very simple. There are 3 categories. Okay, first category challenge A is already ended because the period is from 1st to 15th of the respective month. We are now at 20th December. So for all of you guys, even if you have already claimed this challenge before, you have actually redeemed the gift, you can still join this. Okay, just focus on the challenge B. All you have to do is actually qualify for the AFYP in challenge A and also with a minimum 1 recruit. And for the third highest reward, we have at least 2 recruit requirements. Okay, this is all for the elites in scheme elite life planners. If you want to have more information about this, you haven't actually grasped what is actually the validation requirements, you may check out the R&R or you can ask your respective BOA. Now, because we are running late already, so I'm going to move on to our last slide for today. We want your important feedback, okay? Just scan this QR code, log into your AIA Premier email, and let us know what do you think of today's session. And give us your feedback on what are the other topics that you want to see from our side so we can arrange for you in our next morning meet. Thank you, everybody, and I hope you have a wonderful day today. We have about 11 days left in this month. I wish you all the best in closing strong this year. Goodbye.
Thank you. Bye.
Thank you. Bye-bye.
Thank you.